Welcome to today's panel discussion, Insurance, Ever More Crucial or Losing Ground? My name is John Spence. I'm the Regional Head of M&A and Strategy for Generali Asia and the Chair of the Pacific Insurance Conference to be held later this year in December. The impact of pandemics, economic volatility, and regional conflicts has only magnified and accelerated the fact that organizations are facing widespread uncertainty, ambiguity, and transformation as we shift towards a more global and digital world. Resilience is defined as an ability to recover from or easily adjust to misfortune or change, to bounce back, to get up again. It's a concept organizations need to master to make it in this moment of unprecedented and historic global turmoil. The panel will discuss the role of insurance in the development of a comprehensive resilience strategy. To discuss these issues, we have an esteemed panel of senior leaders. Ashley Hurst will moderate the session and be joined by Paul Hanratty from Sanlam, Joan Lam-Tennant from Equitable Holdings and Alliance Bernstein Holdings, and Wally O'Shine from Custodian Investments. Speakers' bios are included in the material. On behalf of the IIS, I would like to welcome Ashley, Paul, Joan, and Wally to today's discussion. It should be a fascinating and insightful panel. Ashley, over to you.
Hello, and welcome to everyone. Today's panel session on the topic of insurance, ever more crucial or losing ground. Perhaps what we're going to address today is this notion that we're very good, or we've been getting better and better at commercially transferring risk from those who take it to those who are better able to absorb it, those who are better owners of risk. And that idea has been around for at least a couple of thousand years. At a societal level, the mutualization or transfer to wider society of larger risks has been with us for at least the same length of time and arguably a lot longer. For the last few centuries, the insurance market, rooted in our Anglo-Saxon capitalist model, has deployed more and more capital, sometimes with state or societal backing, to transfer more and more risk away from risk takers to those better able to take it. The question our panel will engage with today is whether this model is reaching its limit and what we as an industry can and should do to increase our relevance going forwards. Our positive impact on society in the future, fulfilling our role of moving risk to those best able to take it, might depend on this topic. And so our discussion today, in a time of geopolitical troubles, pandemics, supply chain problems, cyber attacks, rising healthcare costs, climate change, our industry, our mission is ever more important to ever more people and businesses. These accumulating and extremely large risks are, of course, challenging to take. The consequence is that the share of risk addressable by insurance companies and products is declining compared to the total risks incurred by societies, individuals, and companies. How will our industry react? So I'm excited that today on the panel, we're joined by three experts, really with some wonderfully different perspectives. Paul Hanratty, the Chief Executive Officer of Sanlam Limited, Joan Lam-Tennant, Chair of the Board of Directors of Equitable Holdings and Alliance Bernstein Holdings, and Wally O'Shine, Managing Director of Custodian Investments. Right, so in our world full of risk, let's start with how our customers, people and businesses, those with the real fundamental risks, are feeling about the relevance of insurance and risk mitigation. There's a narrative we sometimes hear that some type of version of we have a risk, but the insurance industry only seems to want bits of it. What's your assessment of this? And Joan, maybe I'll start with you.
Oh, thank you. Let me answer this question first with regards to the U.S. life and retirement, and draw from maybe some experience that I'm having at Equitable. Some context would be helpful, perhaps. Customer risk in the U.S. centers around with regards to retirement and protection, dying too early and leaving dependents behind without financial means, or living too long, and without the ability to afford a dignified retirement. Now, both of these result in individual hardships, but they eventually are passed on for generations and ultimately society at large. In the US, 10,000 Americans turn 65 each day. Those Americans are living longer, and they have greater aspirations for fulfilling their life dreams. We think our retirement gap is $137 trillion by 2050, growing $3 trillion annually. Yet, financial well-being in retirement is our business. So this leads to the answer of my question. I actually would agree that the risk of undersaving for retirement is significant, and the insurance industry, the life and retirement industry, tends to deliver products that are offering partial solutions while also serving a very small sector of society, in the US, the more affluent. And we can do more. And I suggest maybe a few areas of focus. First, I'm going to start with innovating retirement solutions that are more responsive to the needs of the customer and that reach a broader range of customers. For example, customers are asking for a solution that offers guaranteed incomes. Some insurers have responded by offering structured capital settlements, allowing the customer to invest in index equities, minimize the downside by capping the upside. This is quite different from solutions of the past that guaranteed a minimum return with inadequate pricing and poor structures. It is important to learn from our mistakes, yet be persistent in finding innovative solutions that are more responsible, but yet deliver on customer needs. Two more I'll just briefly mention is technology innovations improve the ease and the cost of doing business, allowing us to reach a broader range of customers. And last of all, it's really important to recognize partnerships to provide not just a product, but a solution, provide holistic solutions, knowing that we cannot do it all. Now, these are true partnerships where you're working together to improve the economic well-being of the ultimate customer.
Well, Joan, thank you. I think you've given us a few insights into the scale of the life and retirement problem in the US and perhaps some exciting solutions. We're also fortunate today to have two leaders from one of the most economically exciting regions in the world with a very different demographic trend to the US and arguably everywhere else, Paul and Wole. Paul, let's go to you first. Perhaps you could highlight some common themes and differences from Joan's answer with respect to the African market and indeed maybe beyond just life and retirement.
Ashley, thank you very much. I think that I recognize a lot of what Joan says, particularly in the South African context. And I would say one thing about retirement. We face many of the same challenges when we want to help people get adequate savings at retirement. Particularly in South Africa, it's a very well-developed and sophisticated market. And some of the products that she spoke about are ones that we ourselves have been working on. But no matter how good your solution is, you cannot create money in a magical way. And the big thing is that people have to save and invest for long enough. We've obviously been blessed with some periods of very long bull runs, and it, in a sense, often creates a sense of false security amongst people who then feel that retirement is well under control. We now have a period like the one we're in now, where returns are very tough to see. Many people have actually, suffered great hardship. In many cases, people have been laid off work, their businesses have suffered COVID, so there's been a disruption, and they're now seeing themselves as having to work for a lot longer. So I think one of the things on the retirement front and the savings front is that we do need to all spend a lot of time educating people, because no matter how clever our solutions are, there is no substitute for putting enough gas in the tank in the first instance. But actually turning to some other product lines and issues, I think access in Africa is an absolutely massive issue. So one of the things we've been trying to do is to what we call democratizing capital. So actually making the market accessible to people who typically would not have been able to access it. And now that we've got mobile access for people. We've created access to ETFs and tracker products at very, very small premium levels. We've also begun to create access to people across the African continent for very simple health and life insurance. And we've got a partnership with a telco with about 4 million policies. And the average premium there is about 30 US cents a month, to give you an idea. Claims are handled using AI. The AI is very able to distinguish between fraudulent claims and valid claims, because you obviously cannot afford to use human beings to process your business at those sort of premium levels. So in Africa, the big trick is giving access to people. Then if we talk about, the short-term insurance industry, again, I think there's a new range of risks that people face. And that's really, a challenge for our industry. So things like cyber are massive risks that people face. They're not easily insured. And, we ourselves have begun to provide insurance in that area, using a lot of reinsurance to obviously limit the risk that we take as we try and learn how to provide risks that inherently, as everybody on this panel discussion would know, is a difficult thing to contemplate, because you can imagine that it could be a tremendous hole for insurers. And on top of everything else, we're seeing climate change, we're seeing degradation in Africa of infrastructure. We're seeing reinsurers having a very jaundiced view of providing coverage. So that puts a lot of pressure on premiums and so on people who can really least afford it in the world. And so the challenge is, how do you really provide affordable coverage? In many cases, cover it all, when people often will be living in areas that are subject to flooding and so on. How do you do that? And you've got to balance this need to try and help people with the economics of doing it in a sustainable manner. So I think it's a really difficult topic. And whether you're talking about short-term insurance, life insurance, saving and investment, there's clearly an enormous challenge and set of tasks for all of us to try and get on top of.
Thank you, Paul. And Wole, perhaps I'd ask you to build on that and give us your perspective.
Well, thank you very much. I think Joan and Paul, have spoken. And I'll take it from the perspective of reforms that happened in Nigeria a couple of years ago with respect to the pension industry, moving from contributory pension schemes to defined benefits to contributory pension schemes. We thought we had the solution. I mean, there's been a huge progress in that regard in terms of the number of people actually insured and have retirement benefits. But we're beginning to realize that, because of pressure on socio-political challenges, economic challenges, the retirees are making more demands upon retirement in terms of the amount of money that they would want for retirement. And that completely kills the essence of the entire pension business. Hitherto, we've said, you could take up to 50%, of your retirement money upon retirement, and then you get an annuity for the balance 50%. But politically, there's been a lot of pressure, because of the challenges. They're trying to increase it now, such that people take even more. So those are challenges, and we have to find solutions for those people. In terms of the non-life space and in general, Nigeria and indeed Africa have a very youthful population. We have a youthful population, of under 30, roughly about 70% are under 30. That's a huge population. And that's essentially the millennials and the Gen Z, who have a way of doing business and the way of looking at things. So we're seeing demands, for instance, in Nigeria, of people, young people, and the insureds coming up and saying, for instance, that their motor vehicle, they can't afford to pay for a year, and they want to pay per ride. They have expensive vehicles like Porsche or Lamborghinis or whatever, and they only drive it once in a while. Can't they pay per mile and things like that? So there's a huge demand on the industry. Post-COVID, there's been a huge talk about mental health, and we're beginning to ask whether there is any way in which we could actually cover a risk like that, because it's a real risk that has come about post-COVID. Paul spoke about cybersecurity. It's a major risk. Unfortunately, in Nigeria, we're being very careful, in taking on that risk because we don't have backers as such, in terms of reinsurance, who are also, very picky about the way they take such risks. We have also ransom, and kidnapping, because this is another major risk that is evolving, especially in the sub-Saharan area, where you have kidnappings on a regular basis in certain parts of Africa. And these are real risks that people want, covered, that the insurance industry, on the one hand, would love to do it, but are being extremely cautious, and are being very careful. So these are areas that, I think are evolving in the insurance sector, especially in Nigeria and indeed around Africa. Thank you.
Thank you, Vole. And I think it's just reflecting on the last 10 minutes or so. I think so far we've obviously talked extensively about the life and retirement challenge at individual levels. Paul, you've highlighted the role of technology in democratizing access at the smaller premium level. Vole, your reflection on mental health being a question of how it can be addressed. Joan, you've highlighted the gap associated at a national level with the big retirement gap. And I think that, we could also bring in this question about big accumulating risks such as cyber that's been mentioned, pandemics that we've just lived through. Across these very small risks, national level risks, accumulating risks, the scope of insurance itself is very well established in some areas where I think we're trying to extend them to smaller premium perhaps. In other areas, we're still working out maybe what insurance can actually do. Paul, in your role, you look at a wide variety of risks, some taken by an insurance company, others by a bank. Are there challenging areas for insurance that could be handled differently or better by other types of risk takers, financial risk takers? And what could insurance learn from other types of risk takers?
Actually, it's a really interesting question that you put to us. And I think I've spent a lifetime trying to figure out if there is a way, particularly around investment risk, that we can look to the financial markets to do a different job to the one that we do in insurance. And I have to say to you that after a lifetime of looking, not to say that somebody else won't find the answer, I am firmly of the view that insurance is still the cheapest way to cover risks. If you think of a derivative instrument and the two parties that have to come together, and the bank connects the two parties together in taking on that, dealing with that transfer of risk from one party to another. And then the activity, the dynamic hedging that needs to sit behind that. If you price it up and you compare it to insuring those risks, I've never found a cheaper solution in the financial markets than from insurers. And actually this notion of pooling risks amongst a wide number of people, provided there is no, provided the risks are relatively homogeneous and there is no moral risk involved. Actually, I do believe that many, as you said, actually hundreds of years ago, people did discover and invent this concept of pooling risk, which is really insurance. And so it's tricky. It is tricky to find other people, to take it on. And as I said earlier, since the day I began work in financial services, people try to find a way to make 1 and 1 equal 3. And 1 and 1 never equals 3. 1 plus 1 plus an investment return equals 2 point something. Money, like energy, cannot be created or destroyed. It is, it follows the laws of physics. And to try to defy the laws of physics is extremely difficult. Banks, of course, primarily take on credit risk, and again, credit risk depending on which parts of the market you're talking about. So, I think the banking sector is, carved their niche, which is in the credit space, and we found it extremely difficult to ever find a better or more efficient way to transfer risk. And I think we should be happy as an industry that our primary job is is to manage risk, to cut it up, to sell it to people who will take it on. That is actually our job, in the same way that a bank's job is to deal with credit. And the fact that we've all highlighted that there are massive gaps between what the world and our customers need and what we can currently deliver is that there are more opportunities to do more. We just need to be creative and stick at it to find the solutions.
Paul, I think that's good news, I guess, for the industry in terms of the role that you've defined for us. Joan, I'm thinking back to some of the simply extraordinary size of the challenge you identified in your first comment. Are these areas that you think the life insurance industry will handle, or is this a space that you need to bring together and collaborate with other financial institutions?
Oh, I like the choice of the word collaborate, because I couldn't agree more with Paul. It's not, can they do it better or can we do it better? But can we collaborate and collectively do it better? And if you don't mind, I'm going to take a little sidestep here and talk about non-life, general insurance, and then kind of go back to life to answer directly your question. If I could just revert back to my role before governance. I really did have the good fortune. It was a highlight in my career to work in emerging markets and to work in the area of impact insurance. I mean, truly, also known as microinsurance, and truly try to extend our reach beyond and into the underserved. As a founder and CEO of Blue Marble, our mission was to overcome barriers trapping individuals and societies in poverty, and do it by providing safety nets through insurance. Now, we believed, and we eventually validated, that safety nets provided by insurance could incent the smallholder farmers in developing countries to make better investments in their lives and livelihoods. And it was this investment then that they had the confidence in doing, because of the safety nets, that they would improve their well-being. We began by innovating a parametric insurance solution using satellite data that triggered payments to smallholder farmers when their crops were impaired by drought and excess rain. But we clearly understood, and this is where collaboration comes in, that if we're very mission driven on solving a problem, that we in insurance could only deliver a partial solution. That really what smallholder farmers needed, in addition to the safety nets to solve that massive problem, was access to credit, advice on sustainable farming techniques, and access to climate resilient cropping inputs. So we partnered with all of them and embedded our insurance in their services. Now take it a step further, and this is where it got interesting. How do we distribute? Again, we relied on partnerships, collaboration. And one example was a partnership we had with Nestle Nespresso, who gave us access to their smallholder coffee cooperatives throughout Latin America and in many African countries. And basically, through this partnership, we were able to reach the customer in these continents, but we were introduced to them with an element of trust because they trusted Nestle. Now, not to mention, Nestle did not charge Blue Marble a distribution fee. And why? Was it a charitable on their part? No, not at all. Instead, Nestle benefited by securing the well-being of their input producers, which in turn protected the most vulnerable part of their own supply chain, and some could say the most important. So what did we do then in insurance, in life insurance? And the example I like to give is at Equitable, we just struck a partnership with plan administrators of employee-sponsored defined contribution retirement plans. And first, we validated through research that if you had, the 60-40, debt equity portfolio that the plan administrators sometimes default on, that if you added an annuity to it, you lifted that efficient frontier. And in essence, across all, risk appetites, were able to generate higher returns. Equitable recently partnered with BlackRock. And while they administered the employer-sponsored retirement plan for large corporations, and believe it or not, Nestle is one of them, Microsoft is another, Equitable's annuities are offered as an asset class, enabling enhanced returns. And so, obviously, BlackRock owns the relationship, but Equitable owns the solution. And so we partnered to meet and improve efficiencies in a client's needs. And I'd like to say the limit, though, is not just with plan sponsors. There's also ways to partner with governments. I think about what happened in Singapore and Australia and Hong Kong in the early 2000s. They required a means test patterned after what had existed in Chile. And the test then was used to incentivize an individual to really first recognize the problem. Knowing is the first step, right? And in some cases, mandatorily required that it be addressed. But by doing this means test that was mandatory, it incentivized individuals then to start saving for retirement. So those are some examples of partnerships, both in the insurance and in the life insurance and in the general insurance arena.
Actually, I wonder if I can just come back to a point that Joan made earlier around the savings and retirement gap. The one big challenge I think we all have to figure out in our industry over the next decades is how to really democratize the private capital markets. So, if you go back, I suppose, to our parents' generation, it was quite difficult for them to access the share market, the public markets. Today, I think we've made a pretty good fist of that. And it's where the big growth is in investment opportunities, is in the private markets. And I don't know the exact answer on the split between private and public markets now, but I'm sure we're all aware that there's been a huge sea shift. But it's by and large for the wealthy and the uber wealthy. And I think that's a huge challenge for us to crack as an industry. And that's probably a decade or two's work ahead of us.
So, Paul, you were an early thought partner and an inspiration when Blue Marble was started. I'd like to work with you on that challenge, democratizing retirement.
Great.
This might be the start of a beautiful business. Who knows? Look, Verle, turning to you, maybe I'll ask you to step back from the particular problem that Joan and Paul have discussed. Do you think there's an upper limit on what the insurance industry can achieve? And if so, what shapes it? Or is insurance relevant anywhere and everywhere?
Well, like Paul has said, insurance is definitely relevant. But I think we may have to just rethink the way it's constructed, because talking to the younger ones, they do not understand the principles on which we stand on, the principles on which we do business. They see it as opaque, very dodgy industry sometimes. So I honestly believe that we may have to hand over the process to the insureds in a way that they will feel a part of it. And what do I mean by that? Talking to them, I mean, we've seen this especially with, the insurtech companies. What they're doing is more like a, decentralized structure whereby power is sort of like being determined by the people that are there, in terms of, premiums that are being charged, how claims are settled and things like that. I see that, being the future, with the demographics that we're going to be having in the years ahead, because, they want to understand, how did you come about my premium? It's not enough to just tell me pay X, Y, Z, or how did you get it? They want to know. You're paying me a claim or you're declining a claim. How did you come about that? They want to know. They want to be a part of it. So I see that, as the future, whilst not necessarily coming to the conclusion that insurance is definitely not going to be obsolete. It's going nowhere. The principles are well tested. And I believe, that it's only going to grow, but I suspect it's going to grow in a different direction.
That's interesting. I mean, maybe, Bill, I'll ask you to continue with this notion of how it will grow differently. We are an industry that, Paul brought it up again, we've been going at least a few hundred years in our current form. And we've got a lot of established behaviors. As an industry, we're built on the idea that you can take data from the past and use it to project the future. And perhaps a lot of that makes us behave in a fairly reliable, consistent way, for so many good reasons. But what is it about our industry that will set us up for success and that growing relevance you describe? And what is it that will hold us back? And I know, of course, you mentioned you've been involved in pension reform in recent years. And perhaps we could think about this question of what has to change, what has to stay the same for success, not just about insurance, but the whole setup, including regulators, accounting systems, the various different players in the end-to-end value chain. Roland, maybe you'd kick us off with some thoughts.
Yeah. So I think definitely technology is going to have to play a major role. That's going to have to change. The way we access our clients, the way we address issues, will definitely have to change. Joan has spoken and Paul has spoken about collaboration. We're going to have to do a lot more of collaboration, talking about embedded insurance, which is becoming, very popular now. That's an aspect that we're going to have to, capitalize on, getting into areas that otherwise would not have gotten into. They always say insurance is never bought, it is sold. So we're going to have to hide under something. Some people say it's not sexy, it's not a sexy profession, but we will have to hide under, some kind of product lines that are acceptable, to be able to sell our products. And that's I think is a major way forward. And that's been happening. I mean, you have it in the banking sector, you have it, with telcos, even with vehicles, vehicle manufacturing companies that already come with certain warranties, and so on and so forth. So these are the ways that I believe that we're going to be, addressing issues moving forward.
There's a few transformative and exciting changes baked in there. I think embedded insurance is a great example of something that's really, I think, globally now is picking up in interest levels, not just from investors, but customer behaviors. Paul, as part of, in this notion of collaboration, I think as part of your portfolio and your career, you've also been an NED of a telecoms company. And I was reflecting on the fact that that's also an industry that has, just like insurance, a lot of long-term thinking about investment, a lot of standards, interoperability standards that are required to make networks work. And yet has had huge change and disruption in the last couple of decades. Are there any lessons that you think we could learn from that industry and perhaps from your experience in one of the most creative insurance markets in the last couple of decades?
No, so I think what is interesting is that if you look globally, telecoms companies are basically big utilities, and they started out when when the mobile industry kicked off, very high margins and very high growth, and of course enormous value creation. But today it's a mature industry, margins are under pressure around the world, and the people who've really exploited it have been the over-the-top companies, the Facebooks and people like that. But it's quite interesting that in Africa, the telecoms industry has started looking at becoming a financial services business. And if I talk about MTN, which is where I'm on the board, we've got over 60 million customers who do their primary banking now, more than 1 million agents that are like human ATMs, more than 1 million merchants that are taking payments from our customers, and a business that's growing at a phenomenal rate. And I think that once you've learned to bank mobile, why would you ever go back to doing it any other way? And I don't think the traditional banks or the brick and mortar structure can ever compete with that. It's easy, it's accessible, it's cheap, it's efficient, and they've got data. So, I think that this is where, as Wally was saying, there's a massive intersection between technology and our world. And if we can work together to take advantage of that ability to access customers, because if we're honest, that's always been the Achilles heel of the insurance industry. It's that ability to get close and to get engagement with the customer. Then I think there's a great opportunity to utilize some of the thinking that's taken place. If we just stand back and leave it, you will find that the likes of the Facebooks and the Googles will find a way to capture that market, and Microsoft.
Thanks, Paul. It'd be interesting for us to reflect on whether some of these other types of companies are partners or threats. And I think some of the brand names you've mentioned, I know the industry's talked about them in both senses in the last couple of decades. Joan, I mean, I kind of want to ask you again, like, what is it that we should hold on to? What is it we should change? But particularly in the context of that hugely exciting challenge you laid out for us at the start.
Yeah, well, life insurance is, as you noted, one of the oldest sectors in finance, and for good reason. I think Paul nailed it. He said the value of risk pooling is so profound. And so that is something that we should not change. In other words, we should hold on to. We have to recognize and respect the basic economic principles that are the foundations of our business. Now, things that we might want to reconsider. I think it's really important to modernize how we do business. Willie, you've got a very good point. If we don't modernize, how do we bring in the younger generations, and how do we serve the middle class, the lower middle class, and the poor? We've got to modernize. I think we need to become more self-aware that we're not a product push business. We actually have the ability to solve big societal problems. But in doing that, I think we need to rely more heavily on understanding the role we can play and form partnerships to deliver holistic solutions. And by partnering, we can eliminate some of the redundancies in delivering the solution, because we can start to leverage other distribution channels that reach a more diverse group of customers, and in so doing, reduce the costs. So, all of these points we touched on, and but I just give those comments more as a capstone.
Very good. Well, look, I think we're coming to the end of our time. So I think what I'd like to do is invite each of our panelists to give a final thought, perhaps, following the discussion. Paul, I'll come to you first.
Actually, thanks very much. It's been very enjoyable, and thanks for being a very good host and anchor here. So I think what I feel is that the future is bright and essential for our industry. But I would say that probably the biggest task we all have is to remember that we have to educate people. They need to understand, and our products and the whole concept, while we've worked in it all our lives and we think it's simple, it's not that simple. And I think they will benefit as an industry tremendously by educating people. The issues that Wally spoke about with people not really trusting us, seeing products as opaque. I mean, we can address some of that, but we also do need to address the education point. And I think that when you see situations like Ukraine, where the world is crippled from getting grain supplies, until Lloyd's were prepared to insure the first shipment of $500 million out of there. And it is a very dangerous piece of insurance because you're coming through minefields, you've got Russian warships ready to sink everything. That's when you begin to understand why insurance is really important, because if you can't eliminate the risk, that grain isn't moving and people are going to starve. And it's things like this that we need to explain to people in very simple terms. That's what your insurance is about. It's about putting food on the table of middle Americans and middle Europeans who otherwise are not going to be getting any grain out of Ukraine. And we can use stories like that to reinforce the role and to remind people that's why we take away risk, because it greases the wheel of trade, industry, and wealth creation.
Paul, thank you. Wole?
Well, thank you very much. It's been a very interesting session. Well, I'm just going to, end by saying that definitely our industry is going to have to change. Spoken about the younger generation, they're the future. Digitization technology is going to be right there in the center, and we have to start to walk, towards, that area and begin to accommodate risks that are unusual. They may be small from the younger ones, but they're unusual, and we have to begin to accommodate them. There was something I should have spoken about earlier on, and I think that's also important. Our regulators also, have to move from being controlling, to being enablers. Most regulators across the globe, at least in Africa, are more controlling than enabling the industry. And I think if we're going to be dealing with new risks, new ways of doing business, our regulators also have to go with us. Yeah, thank you.
Well, hopefully some of them on the call today will have some thoughts to take away on that topic. Joan, I'll leave you with the final word for the panel.
Thank you. Well, I first want to just thank the IIS for introducing me to Willie and bringing me back together with Paul. It's I hope our paths cross again. I couldn't agree more with what both Paul and Willie had said. So I'm sitting here thinking, what can I say differently? And I think there's one other area that I'd like to touch on. And I'm very proud of the industry and the relevance. I think that's pretty clear. As I noted, that while we need to modernize, we also need to be very competitive in the market for talent. That's a big challenge. We have to educate our customers. We have to modernize how and what we do, but we also have to figure out ways to make a compelling story to attract talent into our business. And, I think we spend a bit too much time on what we do and not why we do it, and the role we play in de-risking and crowding in investments. And I suggest that type of approach would attract many 20-year-olds into our business if they understood better our purpose.
That's a wonderful thought to wrap up on, Joan. Thank you. And look, selfishly, I will say, as someone who's spent my career at the intersection of underwriting and capital markets and tech, it's been fantastic to hear the three of you talking about all three of those areas in the last 40 minutes or so. Myself, I think I'll finish the conversation personally, just with an increased sense of confidence in the role of insurance that Paul, you outlined for us, and Joan, you just mentioned, more confident that we are the right industry to solve some of these problems. And perhaps the more confident we are that we are the right industry to solve them, the easier to develop the collaborations and partnerships with others that, Joan, you first brought up today, whether those are banks or democratized private markets or telecoms firms or even the tech firms. And if we can modernize, whether by better use of tech to drive down cost and develop partnerships with others, maybe even telling our story better to the next generation, as Wole, you brought up first, and Joan, you've just ended for us with, it'll be a very exciting future. So I'm going to leave today's discussion with the renewed confidence that the insurance industry will tackle those vital issues and that we're doing something of fundamental societal importance that will be contributing to for another few hundred years. Thank you to all the panelists, Paul, Wole, and Joan. And it's been a pleasure getting to host the conversation today.
Well, a very insightful session from the panel today. It seems that the answer to the question set for the panel of insurance ever more crucial or losing ground is a resounding response that insurance is ever more crucial. The panel was clear that the insurance industry continues to fulfill its important historical, societal role of providing protection. By mitigating the effects of exogenous events over which our customers have no or little control, such as illness or accident, living too long or dying too soon, natural disasters, loss of property, both virtual and physical, insurance at least allows individuals to limit the financial burden of these events. Indeed, in the case of health insurance, it could even mean the difference between life and death. As insurance diversifies and absorbs the risk of individuals and companies, having insurance is often a precondition for the development of other productive activities, such as buying a home, starting or expanding a business. As noted by the panel, the industry faces a range of challenges to design innovative products and contribute to solving urgent global societal challenges, such as population aging and emerging threats such as climate change or cybersecurity. Joan highlighted the retirement gap in the USA. Paul and Wole highlighted the challenges to financial inclusion and democratizing access to ensure availability and accessibility to insurance in Africa. Today we heard that for the insurance industry to continue to provide contemporary solutions, insurers should pursue a range of opportunities, such as developing collaborative partnerships, implementing digital technology, democratizing access and satisfying generational demand by customizing protection and savings products. Insurance should rightly be perceived not only as protection and risk management mechanism, but more as a partnership that allows individuals and businesses to invest in their future and go where they might otherwise not have dared to go. Thank you, Ashley, for your moderation of the session. Paul, Joan, and Wole for your thoughts and comments today, very much reaffirming the role of the insurance industry and pointing to how we could continue to fulfill our role in society. Thank you.